Welcome back to uh, the fourth episode, which is lecture four. Um, in fact, it's the fifth episode because we recorded lecture three in two parts. So, but we can still take that as part three. So this is part four. This is episode four of our FX Pioneers Trading Institute Foundation. Like as always, we'll be talking about you need to pause and read the risk disclaimer or risk disclosure, as well as the CFTC 4.41 rule. Welcome to lecture 4. As always, we have these two guys who are there, who are there, who are there, who are there. They are here battling they are having a battle for the money, the bears and the bulls. And this is what you will be learning for lecture 4, which is our final lecture. We'll be having the anatomy of the candlestick, pip value, pipettes, lot or lot size, leverage, spread, margin trouble, blowing off an account, deposits and withdrawals, methods of deposits and withdrawals, how long it takes for your deposit and or withdrawals to reflect with respect to the wild factors in the foreign exchange market, the types of accounts in the forex, and how to register a forex account. And again, we'll be going deeper into MetaTrader 4.5 tutorial. We'll be talking about both on PC and on phone. Okay, so we are here on the deposits and withdrawals. These are the means on which you can use in order for you to deposit your funds into your account or to withdraw your funds out of your trading account. You can use Google Pay, Apple Pay, PayPal. You can use your Visa card, Netella, wire transfer, bank wire, Skrill, Bitcoin wallet. There are many. MasterCard, PaySafe card, Astro Pay. There are tons of them. There are many of them. So, since there are different e-wallets in order for you to make deposits or withdrawals, I recommend the banks which are international. You can talk of banks like, for you to use their Visa card as the deposits and withdrawals, you will need to use banks like FNB, which is First National Bank, ABSA, South African Bank, Capitec, etc. These are the banks that offer Visa card, and for you to have a Visa card, it means you can send or receive money from anywhere in the world. So in short summary, this is what actually happens. You deposit your money into your bank account or into your bank. And then after depositing that money, you go to the market. In the market, you trade. What actually are you doing in trading? You are growing your money. You are actually growing your money by doing buy or sell with respect to your analysis. You have analysis, you analyze the market, you analyze the market based on the strategy that you have learned. And after you have learned such strategy, then you be in the position to make buy or sell based on your strategy and your analysis, and then you make profit or loss in the market. There are two things involved. It's either you make a profit or you make a loss. In the case of you making profit, then you will move your money back to your trading, in fact, back to your bank account from your broker's trading account. You deposit money into your bank account. Then you upload that money into your broker's trading account. You trade, you buy and sell, you make profit. You are actually growing your money when you are doing all that. Then you you withdraw that money which is in your trading account together with profits. You withdraw it back to your bank account. Then you can withdraw that money. Don't be this guy who is here miserable because he lost all his funds. He lost his funds because he's not implementing proper risk management. He is not practicing to follow the rules of the strategy that he is using. He has chosen the weakest strategy. He doesn't know anything, but he wanna make money. Don't be this guy. He lost all his funds. Look at how he is. Man, it's gonna be alright the other day, man. You gotta stand up and you gotta go and learn and back test some good strategy out there, and then you could be profitable. How long can it take for your deposit or withdrawals to reflect with respect to the wild factors in the foreign exchange market? It really depends on the market, on the broker that you're using. Some other brokers, it may take 1 day for for your deposit or withdrawal to reflect. Others may take two, others may take three, others may take five, but you have to bear in mind that they process your your funds or your withdrawals in the only working days. They will never ever process your funds on weekends. They will process your funds in the working days. So while you are choosing a broker, you need to understand how long does it take for them to process your withdrawals, regardless of any place that you are in the world. So types of accounts, we have what we call a demo account and a real account. So a demo account is the account, it's a practice account. It's an account that have simulated funds. You use that account in order for you to back test your strategy, to test your profitability. You place trades, or you have ability, or you are allowed to place trades of buy and sell and make profit or loss, and therefore you are validating your strategy, you are validating your trading mechanisms that you are using. So actually that is a demo account. It's the account that is made for you to practice. Hence why I say it's a practice account. You practice all the concepts that you have learned, and before you do this, before you could deposit your real money, which is your real funds. So this is actually a fake account. It's a fake account. It's a money that is fake. The money that you cannot have access to. You cannot withdraw such money. You cannot use it. You can only trade with it. Even if you make profits in a demo account, you cannot withdraw that amount of money that you have made together with a amount that you started with. So there is what we call a real account. A real account is the account that you have actually deposited money from your bank account. This is the money that you can use to make withdrawable profits. You can withdraw any amount of money that you have deposited, even if you have lost. You can deposit. You can withdraw the remaining amount because it's yours. But bear in mind that each and every broker has a bare minimum or the minimum amount of money that you can withdraw. The minimum amount that you can withdraw is different for any broker. So we have different types of brokers. In fact, different types of accounts that you can open on any broker. They offer different types of accounts. All these brokers. We have what we call a standard account, which is suitable for most traders. We have a micro account, which is suitable for small risk takers or people who like small risk or take a small risk. Then we have what you call an ECN account. It's the account whereby you will be making trades that will go direct to the market, and they have a very low spread. This type of ECN accounts, they have very low spreads. And then we also have brokers offering what is called Islamic account, which is a swap-free trading for the Muslim traders. This is what we call Islamic account. And then the following, these are all the things that I want you to know as a beginner, and you must know these things. So let's make a quick recap on this one because we talked about it previously. We said the market is moved by the market makers or liquidity providers. You can also call them smart monies and dealers. They move the market with respect to supply and demand based on their goals and their objectives as to what they want to achieve. So, you know for sure that you can make money trading with respect to whatever we talked about on the previous lecture. The minimum amount of money that you can make per day, it depends on the lot size. It depends on the strategy that you are using. It depends on your profitability. Depends on the leverage that you are using. Uh, this is what I can actually say if you ask me what amount of money can I make per day. What is the minimum amount of money that I can make per day? You can make money based on your lot size that you're using and with respect to your account balance again and again with respect to the leverage that you are using. There is no fixed amount that you can use, that you can make. It only depends on your scale, your capital, and the market conditions if they apply for you to make a trade of buy or sell. And beginners may make a small profits and they may lose much money initially. They may lose a lot of money initially. While experienced traders can earn few dollars to thousands per day, which is these are experienced traders. So what is the minimum amount that you can start with in order for you to trade? I would recommend $1,000. I would recommend $1,000. But does it mean that if you happen not to have $1,000, you cannot trade? No, you can trade. You can make money even if you don't have $1,000. You can grow $100 account to $1,000. You can grow a $50 account to $1,000. You can even grow a $10 account to $1,000. You can even grow a $5 account to $1,000. But how much time can you make? I don't know. It depends on your skill. It depends on the market conditions, and all other factors that we talked about. You know, so let's talk about some forex basics. Let's talk about some forex basics. Uh, let's talk about the anatomy of a candlestick. A candlestick, it's a form of indication of price movement. We have what you call a bearish candlestick, which is this candlestick, the red candlestick. It's a bearish candlestick, bearish for the movement of the market to the downside, bullish for the movement of the market to the upside, indicating the upside of the price movement. So each and every candlestick has the opening price, low price, the higher price, the closing price. Each and every time the market opens, and the candlestick is moving, the market will form open of the candlestick, low of the candlestick, the high of the candlestick, or vice versa. And then the market will form the closing price of the candlestick. This means that we can only have open, high, low, close, or open, close, high. In fact, open, high, low, close, or open, low, high, and close. We have a bearish candlestick, we have a bullish candlestick. Red candlestick is a bearish candlestick. It indicates that the price is going down. And the bullish candlestick is the green candlestick, indicating that the price is moving up. You need to understand this before we go further. On your platform, you can choose the color that you want your bullish candlesticks to be and your bearish candlesticks to be. It's your choice. You can choose, you can customize the colors, and then you can choose what you want, what could be more appealing to you or understandable to you. So let's talk about the currency pairs structure. This suppose there are some other guys over there. This guy wearing a hat with beard on him, and it's like he's smiling or he's closing his eyes. I don't really know. And he's a dollar. He's a US dollar. And this other guy wearing a hat, a cowboy hat, and with some kind of a leaf on his I don't know whether it's a trouser or whatever he's wearing, the yellow guy, who is a Canadian dollar. So suppose we have this type of a structure, US dollar CAD or USD CAD is denoted with a slash in between. This means that this pair, when you call it collectively, it's a pair, it's a currency pair. It's a USD CAD. This is how you call it, USD CAD. Or USD versus CAD. Or United States dollar versus Canadian dollar. So the first currency, which is US dollar, is called a base currency. And the second currency is called a code currency. The first one is called the base currency, and the second one is called the code currency. I'm talking of USD and CAD. USD will be base currency and CAD will be the code currency. Let's talk about another example. Let's take Euro USD for example. Taking Euro USD for example, Euro would be the base currency and USD will be the code currency. The first price that we see written 1.0670 is called the base currency price, but you can call it bid price. The second price that you see for the code currency is called ask price. So the last numbers on the price indicate the amount of pips. If the market moves with you buying or selling Euro USD as a currency pair, in this case, the last two numbers on the prices of bid price and ask price, they would indicate the amount of pips that the price has moved. Suppose, for example, the price was at 1.0627, then the price moved to 1.0672. It will simply mean that the price has moved 2 pips. So in this case, we are not talking about the movement of the price. We are talking about the base currency and the code currency. I want you to get me well. So the difference between this code currency and base currency is called a spread. The spread is the difference between the code currency and the base currency. The spread is what you pay for you to make or to conduct the business of trading. You pay spread. So this is what you pay. You will pay spread of 2 pips in this case for you to buy or to sell your USD. I hope you understand that very well. So we are still on the currency pair. We are still on the currency pair. In this case, Euro USD, like we said Euro is base and USD is code. And you will understand that when you sell Euro, you are buying US dollar. When you are buying Euro, you will be selling US dollar. When you buy Euro, you sell US dollar. When you sell Euro, you buy US dollar. It's vice versa. This is how it is on this currency pair, which is Euro USD. It will be the same for any other currencies that are paired. This is how it's done. This is the important details of them. When you buy the base currency, you are selling the code currency. When you sell the base currency, you are buying the code currency, vice versa. So we all said that the difference between the bid and the ask is what is called a spread. In this example, Euro USD as a pair, we have the bid price as 1.13281, and then we have the ask price as 1.13287. You would say 1.13287 minus 1.13281. This would give you the spread of 0.0006. This is actually a spread. So this is how you could manually calculate the spread if you want to. You would say ask price minus bid price. It will give you the spread. Okay? So moving on to the major currencies in the world. The major currencies in the world are US dollar, which is abbreviated as USD, and euro, which is abbreviated as EUR, and GBP, which is Great British Pound, abbreviated as GBP, Canadian dollar, abbreviated as CAD, JPY, which is Japanese yen, abbreviated as JPY, and Australian dollar. These are the major currencies in the world. And then there are major currency pairs. Major currency pairs are all these currencies, major currencies, when they are paired with US dollar. This is all of them. When they are paired with US dollar, they are called major currency pairs. We have Euro USD. You can see there's USD in there. We have GBP USD, USD JPY, USD CHF, USD CAD, AUD USD. These are major currency pairs. We said they are major because they are paired with Euro, they are paired with US dollar. So all other currencies, when they are paired, all these major currencies, we talked of the major currencies, which is US dollar, which is USD, Euro, GBP, CAD, JPY, and AUD. All these currencies, major currencies, when they are paired among themselves, they are called cross currency pairs. They are paired among themselves. For example, we have euro. Euro crosses or euro cross pairs are euro GBP, euro CHF, or euro CHF, however you may call it, euro CAD, euro AUD, euro NZD, euro JPY. I don't like NZD, and NZD is not what I trade, but you can consider it as a major pair as well. So these are all the major currency. These are all the cross currency pairs. These are all the cross currency pairs. And the exotics are the currency pairs that are paired with exotic pairs are when these other major currencies are paired with other currencies that are not traded that much in the market, like like fellow Danish krone, Singapore dollar, Turkish lira. There are many. Swedish krona, South African rands, Norwegian krone. There are many. There are many. They are called exotic pairs. These are the when the major currencies are paired with the currencies that are not traded that much in the market, that are not traded by many people. They are called exotic pairs. So we'll be moving on talking about the PIP, which is the smallest price movement, lot size. We'll be talking about the standard trading size, and leverage. We'll be getting into detail with leverage, which is the borrowed money to increase your trade size. We'll talk about spread. We'll talk about margin. We'll talk about you blowing account or anybody. We'll talk about major currency pairs, blah blah blah. We'll talk about the types of orders. We'll talk about buy, sell, stop orders, take profits, buy, sell limits, buy, sell stops, taking partials as well, and we'll also talk about the best forex trading strategies, recommendations. So there are types of trends in the trading market. we have what we call an uptrend. We have what we call a trading range or a sideways trend. A sideways trend, and we also have what you call a downtrend. Uptrend is when the market is trending to the upside or when the price is increasing to the upside. This is what we call an uptrend when the price is moving up. And then we have a sideways movement or a sideways trend. Or a trading range is when the market is moving in a range, kind of not going up, not going down, but going up and down in a specific range, not trending. The price is not trending in a sideways trend. It's not going up straight away or not going down straight away. It's ranging, it's consolidating. The price is in consolidation. That's what we can say. We know for sure that when the price is going up, it's forming higher highs and higher lows. When the price is going down, it's forming higher lows and, in fact, lower highs and lower lows. So, for us to say that the price is going on a sideways movement, it will most definitely not forming higher highs and not forming lower lows. It's just forming a series of highs and a series of lows. That is what we call a sideways trend. Could be example one of the trend. We have the uptrend over there indicated with the blue line. Downtrend, the market was trending down in this case, and the market moved in sideways, and then the market trended up again, down again, up again. So you need to understand and you need to be in the position to fully observe when the market is trending, because we want to trade the market that is trending. We are not looking to trade any market that is not trending, because we are looking to make profit, since we said that for us to trade, we will be buying low and selling high. If we buy low, we are anticipating the market to go up. But if we are selling high, we are anticipating the market to go down, to go low in price. So if you want to make profit, you want to profit for the market, you need to buy low and the market needs to go up for you to make a profit. But if the market does not go up, it goes down while you have bought, you'll be making loss. If the market will be going low while you have sold, in fact, the market will be going up while you have sold, you will be making a loss. Another example of the market trends. We buy when we anticipate the price is going to go up. When we anticipate that the market will be trending up, and then we sell when we anticipate that the market will be trending down. So this is another example of uptrend, downtrend, and sideways trend. This is what typical will be happening. For us to say this is an uptrend, we'll be having a market that is trending up, and then for downtrend, we'll be having the market that is trending down, and for sideways, we'll be having a market that is forming a series of lows and a series of highs. Okay, let's talk about a pip. What is a pip? Pip is the smallest price movement, like we said. It's the smallest price movement in price. Let's take an example. Let's talk about USD/JPY. We all know that USD is a base currency and JPY is code currency. So for this example, suppose the price is moving from the price of 1.4, in fact 114.08 is moving from that price to the price of 114.09. Like we said, the last numbers on the price, they indicate the price movement or the amount of pips. So from the price of 114.08 to 114.09, this will indicate that the price has moved only one pip, as you would say, or you will calculate it in this manner. You will say 114.09, which is base currency, minus code currency, which is 114.08. Then you would see that the market has moved only one pip. So for you to trade, you need to understand the pip value. What's the pip value? The pip value is the value that you would get, or the value of one single price movement, which is a pip. The value of one single price movement is called a pip value. So for you to see the pip value, you would say amount of pips divided by exchange rate multiplied by the lot size that you are using in your account. There is different pip value for standard lot, micro lot, and minimum lot. We all know that standard lot is most definitely 100,000 units, and then we will have micro lot, which is most definitely 10,000 units, and then we will have mini lot, which is 1,000 units. They are all equivalent to those units. Standard lot is equivalent to 100,000 units. Micro lot is equivalent to 10,000 units, and mini lot is equivalent to 1,000 units. So in this case, in this example, suppose we are doing a calculation of a pip value for a standard lot. While you are using a standard lot, then we want to know that you're using a standard lot. Suppose it's a lot size of 1. Then you want to know that let's not say lot size of 1. Suppose you want to know that what is the value of 1 pip for a standard lot. If you are going to use a lot size of 1, what will be the value of 1 pip? If the price moves 1 pip with you having made the buy or sell using one standard lot, what could be that the value of that pip? So you will say pip value is equals to 0.0001 divided by exchange rate. Amount of pips in this case will be having 1 pip, which is 0.0001. This indicates 1 pip, and then divided by exchange rate. Suppose exchange rate is 1.2229 multiplied by 100,000 units, since we said that for a standard lot is equivalent to 100,000 units. This would give you $8.17. In fact, this could give you 8.17, which is equals to $10. This indicates that for market to move 1 pip with one standard lot, when the market moves 1 pip, it costs $10. If you have made a buy and then you are in profits, the market just moved 1 pip in your favor, then you will have made $10. This is what actually this means. So we have different pip values for different currencies, basing ourselves onto whether they are major currency pairs or cross currency pairs, or whether it could be commodity pairs. You know, they have different pip values dependent on which they are or what they are. In this case, for USD JPY, for market to move one pip, the this would cost you $9.6, $9.64. For market to move in your favor with one pip, you will be making $9.64 US dollars. For Euro USD, you will be making $10. That's how different they are. There is different pip values for JPY pairs and for pairs without JPY. For pairs with JPY, it's actually 0.01, and for pairs without JPY is 0.0001. So this is the table that shows you the in fact the pip value for each and every currency pair. For major currency pairs, for a standard lot, Euro USD and other major currency pairs, they would usually cost $10 per pip. One pip is equals to $10 with one standard lot. And for USD, in fact, for JPY pairs, it will usually cost 0.01 pip, and that will cost approximately 9.13 for most of them, depending on the exchange rate. You know, this pip value is calculated based on the current exchange rate. You cannot calculate it based on the previous exchange rate. You calculate it based on the current exchange rate. So this is a table that you can pause and you can look at it for yourself and see as to the pip values of different currencies that you might want to trade. We all know that Euro USD is the most traded and it's very highly liquidity. It has high liquidity. It's very high liquid or highly liquid. And GBP USD is more volatile than Euro USD. And Euro, in fact, AUD USD is commodity linked currency. You can read NZD USD, slightly less volatile. USD CHF, safe haven currency. It's referred to as safe haven currency. USD JPY, the value of your, in fact, USD JPY, it varies based on the rate of exchange. GBP JPY is very highly volatile. Euro JPY is just a popular cross pair, and Euro GBP it has a very high pip value to GBP base, and it can go as far as all of them, but we all know that gold, which is XAU USD, is volatile due to GBP. No, not GBP, but it has more pip value than currencies. Moving on to the lot sizes, we said that for a standard lot, we refer to 100,000 units. In case that you are making a lot size of 1, that means that this lot size of 1 represents 100,000 units, and lot size of 0.01 or a mini lot, and others could be 0.01, 0.02, all the way up to 0.09. They are called mini lots. They could represent what we call a mini lot, which represents 10,000 units. And then we have what we call a micro lot. Micro lot, we could talk of lot sizes like 0.01. This one, many people do it. 0.01, 0.02, 0.03. Yeah, it's called a micro lot. And then micro lot is equals to 1,000 units. And then finally we have what you call a nano lot. Nano lot is equals to 100 units. It's equals to 100 units per nanolot. One nanolot represents 100 units. Suppose we had bags and we were representing the lot size with the bag, or the amount of impact that they have, or the amount of money. We could represent them like this one, like this picture on the right side of this one that has charts. For a micro lot, we could have a bag of that size, and for a mini lot, we could have a bag of that size, and for a standard lot, we could have a bag of that size. You could understand that for a nano lot, you could have a bag that is smaller than that one of a micro lot, which is lot size of 0.01. So let's talk about some leverage. Let's talk about leverage. Let's dive deep and talk about leverage. For a leverage, or for leverage, you are actually have a small amount of money in your account, but you are given a privilege for you to make trades, or you are given a privilege to have a bigger buying power. You have a small amount of money in your account, but because of leverage, because of giving leverage at your disposal, you have a big buying power that is bigger than the account size that you have. Let's make an example. Suppose that you have $200 in your account, and then you are given leverage, or you are given access to leverage. So, because of leverage, or being given access to leverage and having access to use it, you can now be in the position to make orders that are equivalent as to when you had $10,000 in your account. But in this case, you know that you will be having only $200. With that only $200 that you have, you could be in the position to make trades that are equivalent as to when you have $10,000 in your account. This is the power of leverage. You you have to use leverage in a sense that it could benefit you, because excessive use of leverage could again be against you, because when what happens when you go to losses and you have used a lot of leverage, your account goes out, your account goes down, you blow your account with a split second. So this is another example. Suppose you have $1,000 in your account, and in this case, I want to make an example of a leverage. Suppose you have or you are using a leverage of 10 is to 1 or 1 is to 10, however you may put it. And this is a seesaw. It implicates, or it simply shows you that with 1,000, with the leverage of 10 is to 1 or 1 is to 10, you could be in the position to buy or to sell or to make orders that are worth or that you could make when you have $10,000 in your account. So, in conclusion, this is what actually is happening. The lot size that you are using is equals to the risk that you are taking when you are taking any trades, when you are making any buy or sell. And the leverage that you are using is equals to what we call your margin. You cannot trade beyond the leverage that you are using. Hence, that is equals to the margin that you are allowed to use. We'll go on. We'll talk about the margin deeper on the next slide. Okay, so let me make an example. Suppose you are given, in fact, suppose you have $500 in your account, and when you have $500 in your account, and you have chosen leverage, or you have chosen to use leverage of 1 is to 500, or 500 is to 1, however you may put it. Using this leverage of 1 is to 500, having $500 in your account, this means that you can open trades that are worth or that are equivalent of when you have $250,000 in your account. This means that $250,000 in your account is the amount you are given a loan. You are given a loan. You are given a loan of whatever amount that is. You are given a loan of 249,500. You are given a loan of 249,500 in order for you to trade with this leverage of 1,500. Remember, we said that leverage is actually a loan that you are given by the broker in order for you to give you a trading edge. So we also have what is called a margin call. Remember, we just said that lot size is equals to your risk, and we also said that leverage is equals to the margin. We just said that. So now we are talking about margin call. This is actually what happens. Suppose you are an investor or a trader. You deposit $10,000 in your account, and then you buy a currency or you buy a stock that is worth of $10,000. In fact, that is worth of $20,000. You have $10,000 in your account, and then you buy a stock that is worth $20,000. This is what the broker will do. The broker will give you uh, additional will give you additional money for you to execute your order. And that additional money, we all know that is leverage, but we will have a certain margin that you cannot cross, which is what we call our margin. And for you to for the market, when the market goes against you, for example, and you are making a loss, when you are making a loss, there is a certain state or amount of money that when the loss reaches that amount of money, the broker will give you what we call a margin call. A margin call means that you are experiencing a loss that is not permitted as to the amount of money that you have in the account. Let me make another example. Suppose you have $2,000 in your account. If you have $2,000 in your account, when the your loss reaches $1,000, the broker might give you a message to say that be aware of your margin. And when your loss reaches somewhere to the 83% of your 83% of your account, you will get what we call a margin call. Most of the brokers, they will give you a margin call or the message that tells you that you have used all your margin or you are in margin trouble. You are in risk of losing all your capital. Then you will get what we call a margin call. A margin call doesn't mean that you are getting a call from a broker. It's simply a message that tells you that you are about to lose all your money. Be aware. You have crossed over the limit that you need to be, where you need to be in terms of the loss. Then you will get what we call a margin call. Most of the brokers will won't allow most of the people to lose 30% of equity. Most of the brokers will allow you to keep 30% of equity. And most of the brokers, when you reach a loss of 30% of equity, they will give you margin call. Most of them, they will give you margin call. We have discussed previously that the spread is difference between the bid and the ask, like this. And this is another example of how to calculate the spread, like we have did before, similar to the other one that we have done before. And this is another example of how to calculate the spread. So let me show you the spread on the chart. We said the spread is different between the bid and the ask. This is a chart. This is a real chart. Below is time, days, months, and on the right vertical side is price. In this case, On this case, the order was being made, hence why that tail appeared on that side. So the difference between the bid and the ask is demonstrated here on the chart. We have the ask price right there, and then we have the bid price. And the difference between is called spread. Even here, we have the difference between the bid and the ask. We have the bid price, we have the ask price. The difference between is called the spread. There it is. It is clearly demonstrated on here. And then we have types of orders. We have types of orders in the market. We have what we call market execution. Market execution is the type of order that you will buy now and expect your order to be filled now, or sell now, expect your order to be filled now. Stop order is the type of order whereby you will be expecting when the market to reach certain conditions to stop you out. Take profit, you will be expecting when the market to is reaching certain price area on the chart. You will be expecting the market to stop you out and take whatever profits that you have made. Stop loss stops the loss. It limits your losses. And take profits, it stops and takes whatever profit that you have made. And then we have what we call taking partials. Taking partials, let me put it in this way. Suppose you have made an order, you have executed an order on the basis of market execution, which is the order that is made in real time on the basis of now. You have executed a buy order, the market goes in your favor, and then you make profit with lot size of 3, standard lot. Then you could take profits of lot size of 2 and leave lot size of 1 profits running. You can take partial profits for lot size of 2 in the 3 and then leave lot size of 1 still running. That is called taking partials. And then we have what we call stop orders, buy stops, sell stops, which are orders that you want the market to buy or to continue buying, to execute your orders of buy when the price reaches certain point, or to execute your orders of sell when the price reaches to the certain point, or to execute the orders of sell if the market was still going up and then you predict the market will be going down at a certain price point, or to execute the orders of buy when the market was going down, when you anticipate that when the market reaches a certain price point, the market will go up. And then we have limit orders. Okay, we'll talk about them shortly. Let's talk about stop loss. In this case, we decided to buy. We decided to buy anticipating that the market will go up. If we buy, our stop loss will be below the price where we just bought. We will put our stop loss certain amount of pips from the price point where we bought. So this means that our stop loss will be below when we buy, and our stop loss will be above when we sell. Will be above our selling point when we sell. Stop loss again will be below our buying point if we are buying. This is the first example. We bought on the green line, where the green line, on the green line we bought. We anticipated that the market will be going up, but the market didn't go in our favor. It went opposite or against us. Therefore, if the market goes against us, we will have to have risk management in place, which in this case is our stop loss, which will limit us from losing our entire account funds. Therefore, in this case, we will talk about take profit. On the basis of take profit, we anticipate that the market will be going up to that level that is indicated with red dotted line. And therefore, when the market reaches to that price, the market should take whatever profits that we have made and close everything. So we bought, in this case, on a green line, anticipating that the market will go to that red line that is dotted red line, red line, hoping or anticipating that the market will reach that price point, and when it reaches that price point, our take profit will make sure that our order is closed, and with all that profit that we make from the buying point to that take profit in our bag or in our trading account balance. So let's make an example. In this case, consider the yellow shaded area as our reward, and consider the red shaded area as our risk area. So suppose we want to buy. If we are buying, we place our let me do this. We will be placing our buy order right here, anticipating the market to go and hit our take profit, and our take profit will be right here. Our buy order will be here, and our stop loss will be below. Remember, we said when we are buying, we place our stop loss below, and when we are selling, we will be placing our stop loss above our entry price point. So in this case, we will have bought, and then the market has went in our favor. It moved in our favor until it has hit our take profit, which is TP, abbreviated as TP, stop loss abbreviated as SL. In this case, we'll have bought right here, and then the market went in our favor and then hit our TP. This means that the market has closed our order, which is a take profit order, with our profits that we have made from this point to this point of take profit. In this case, we anticipated a sell. We anticipated that the market will continue going down, and then we have sold right here. We have placed our selling order, and then the market went against us but failed to hit our stop loss, and then the market continued to go in our favor until it hit our target, which is take profit right here. In this case, we decided to we anticipated a buy position. We placed our buy right here, and we placed our stop loss right here, and market went up in our favor. It failed to hit the take profit for the first time. It went back to the entry point, and again went for the second time to hit our take profit. This is why these orders are very important. This is why they are very important. So having ability to use them, and being able to manipulate them and use them, being in a position to take partials, This will give you a very much good trading edge. Let's take an example. Let's make another example. Another example is right here. In this case, we are we are we are in a bullish market. We are in the bullish market. The price is moving from this point, it's moving right there, and then we anticipate that the market will continue going up. Hence why in this case we decide to put our order of buy right here, and our stop loss goes below the entry point, so that if the market goes in the opposite direction, the market stops us out, and we will be taking a small loss, not a big loss. Therefore, we will still have amount of money that is left in our account for us to trade. So in this case, the market went against us through a pin and went against us again. It went against us, consolidated, went against us, but failed to hit our stop loss, and again went back into our favor. It went back into our favor, and in this case you can put multiple take profits with respect to the amount of trades you have taken. In this case, suppose we have taken two trades, two buy trades. This would be our take profit one, and this would be take profit two. Or we could take, suppose we have made one position, we could take 50% of our trading profits right here. Why we will be taking this will be when we will be taking partials or partial profits. We would take 50% of the trading or floating profits right here, and we will take another remaining 50% of the floating profits here. So this could be our TP1 and TP2 if we have made two entries. But if we have made only one entry, we could take first partial and we could take second partial right here. Let me make another example of a stop loss entry. In this case, the sell order is placed right here. The sell order is placed right here. In this case, the market is anticipated to go down with respect to the analysis that are made. The market is anticipated to go down. If the market is anticipated to go down, we said we place a sell order and then we put stop loss above the sell price point or the entry of sell price point. This is the entry of sell. This is the entry of sell, and we have sold right here. We anticipate the market to go down. We put our stop loss above our entry point, if so that if the market goes in the opposite direction where we have not anticipated it to go, then the market will stop us out with this stop loss. So we are here. Remember that we are looking for the market to go down. If ever the market doesn't go in our direction, which is down from here to the downside, the market should stop us out with this stop loss. Then afterwards, the market went right down from our entry price point just to the downside, and we adjust our stop loss from this point to this point. In this case, I haven't taken any partials. So this is a stop loss order. I could have put take profit order somewhere here, then the market could have hit my take profit. Okay? So moving on, we have what we call a buy limit order. A buy limit order is an order to buy at or below a specific price. Buy limit order. In the buy limit order, in this case, the current price is still going down, and then you anticipate that when the market reaches a certain price point, it will go up. Then you would place what we call a buy limit order. And then we have what we call a sell limit order. Sell limit order is vice versa of a buy limit order. In this case, you anticipate that the current trend is still, the market is still going up. Then you anticipate that when the market reaches a certain price point, the market will go down. Then you will place what we call a sell limit order, so that if the market reaches that price point, the market will go down in your favor as you anticipated, failing which you will have to incur a loss. So in this case, we have a current price point for a buy limit order. The price is still going down. Then you place your buy limit order, so that if the price reaches this point, the market will open your trade of buy. That type of an order is called a buy limit order. The market will open your trade of buy with you anticipating that the market will go up. Therefore, you will place a buy limit order. A sell limit order, you anticipate that the market will go down when it reaches to some point. The market is still going up. The market is trending up, but you anticipate that when it reaches to a certain price point, it will go down. Then you place what we call a sell limit. And we have again what we call a buy stop. A buy stop, for a buy stop, you anticipate that the current trend of the price is going up. You anticipate that when the market reaches a certain price point, it will continue going up. Therefore, at that point where you predict that the market will continue going up, you place what we call a buy stop order, so that the market opens your order and then it continues going up. And we have again what we call a sell order. For a sell order, you anticipate that the market will continue going down when it reaches to a certain price point. The current price in this case is, the market is going down. And then you anticipate that when the market reaches a certain price point, it will continue going down. Therefore, you will place what we call a sell stop order. For the market to open your sell order when it reaches to that specific price point. And moving on, let's talk about blowing off the account. The term blowing account it simply refers to the act of you losing in a foreign exchange market to a point whereby you do not have any funds in your trading account as capital for you to trade with. I have some few recommended strategies that I want to recommend to you for you to use or for you to learn and implement or backtest and actually use. They are very profitable in my own opinion, and if you learn one of these strategies, you will be a beast in the market. But I personally use one. But first of all, let's talk about why would you go into trading. Before I recommend to you the strategies, why would you go into trading? Most definitely, you'll be going into trading as to add to your income or to do some kind of supplementary income, or you might want to go into trading in order for you to be trading full time. So these are my recommended strategies. You want to know how to trade, you want to master trading, learn one of this one. You just take one and you master it, and then you'll be the beast. You'll be the beast in the market. You'll be profitable. You'll be highly accurate. You will make highly accurate predictions. But myself, I just use one. I trade BTMM, which is beat the market maker method. I trade it only pure BTM. Don't mix it with anything. I don't mix it with anything. It's just a pure BTM. You can also learn ICT, which is inner circle trader. It's a very highly profitable strategy if you use it and use it well. We have the other one which is called wake off. Hey, the people who are using these strategies, wake off. Ah man, they enter sniper entries all the time. Like us, like BTMM traders, we are always on sniper entries, and also ICT traders. We are also they are also sniper traders. Let me not say we because I'm not using any ICT, but the hell am I saying? So we have wake off. We also have supply and demand. These are the strategies that I recommend personally. If you take one of them and you learn one of them, then you will be most definitely highly profitable if you would understand them well and implement their rules very well. So let's talk about some softwares that we use in trading. There are many of them: MetaTrader 4, MetaTrader 5, C Trader, Mesh Trader, Ninja Trader, Trade Locker, Trading View, DX Trade, JFX Trade. There are many. There are many. You just need to just take the one that you feel like it resonates with you, or you can use it easily. You can just choose that one that you think it's easy for you to use. So let's talk about MetaTrader 4. In order for you to use MetaTrader 4 or MetaTrader 5, you need to first download it. After you have just downloaded it, you need to log into it. You need to create an account and then use that account that you have created for you to log into it. And you need to have market watch for you to watch or to see whatever you could trade. Could be currency pairs, it could be anything, it could be stocks, it could be commodities, it could be anything. So in order for you to see and observe the availability of the pairs that you could trade, the commodities, you have to open what we call market watch. And then you could open the chart to observe the price movement of anything that you have selected. Suppose you are in the currency pairs and then you select Euro USD. In order for you to see Euro USD, you will have to open the chart in order for you to observe the price movement of the Euro USD. And then in order for you to take entry, you will have to open what we call other panel and or other window. Then you could actually see the buy and sell buttons where you will be prompt to, in fact, where you will have to input the lot size and the type of order that you will be making at the moment. Then you could place your order, but remember first you select the lot size and then you could place buy or sell. And again, you could be in the position to close the trade later on. So how to actually use MT4 on our Android phones? How to use it? This is a picture of an Android phone with MT4 platform opened on it. So we actually have this. We have a plus sign. This plus sign over here is where you would add the account, or it's where you will click in order for you to log into your trading account. When you click here, you would actually select that whether you are logging into already existing account or opening a platform demo account. By a platform demo account, I mean meta codes demo account like this one, which has a 5 million US dollars in it, or yeah, and this other one also has $5 million in it. So this is actually what you will come across. Then you have to click here on this plus sign, and then you log in using your login details. Then the account will appear in your window like this. This shows that this account is logged in on this device. This is a demo account. And for you to add anything that you want to appear in your market watch, this is the market watch. For you to add anything that you want to appear here, you will press on this plus sign. You press on this plus sign when you have logged in. For you to see this plus sign, first of all, you have to come here and you press on this arrow. When you press on this arrow, you will see the currency pairs or anything that is already added in here on your market watch. Then you press on this plus sign. When you press on this plus sign, there are assets, or yes, there will be assets or categories of things that you may trade or you may want to trade. When you press on them, most definitely you will see forex, spot metals, CFDs, commodities, exotics. It differs based on the broker that you are using. Okay, then you will go in each one of this and then add whatever you want to appear on your market watch. Whatever you will be selecting in here will be appearing on your market watch. Remember, this is your market watch. This is your market watch that you see when you have selected this icon right here, this arrow icon, this one. When you have selected this icon, you will see your market watch. So whatever you see here, you add it by getting in these folders and adding it to your market watch. Whatever you will be selecting in here will be appearing to your market watch. And after you have added them, this is how they will appear. They will appear like this in your market watch after you have added them. So here, this icon, you use this icon to see your market watch. You know, when you are in market watch, you can also add other things, or you can also remove them. In order for you to remove anything that you want to remove, you go to this pencil icon and then you select on anything that you want to remove, and then you will click on the trash icon that will remove anything that is in here in your market watch. But bear in mind that the chart or anything that you have opened in the chart cannot be removed. You can only remove anyone or anything or any currency pair that you have not opened in your chart in this icon. So you see your market watch here. Get to see your market watch here. You get to you long press on any of the currency pairs here. You long press and you select chart. Then when you select chart, this icon will be highlighted like this one. But if you want to go to see the market watch, you will click here. You want to go back to you want to go back to you want to go back to no, don't want to go there. I'm still here. You want to see your chart, you go to this icon This is actually our menu icon, menu icons. This is our menu bar. You observe our market watch in here. You see the chart window. In fact, you see our chart here, and then in here you could see the current running trades as well as your balance, your margin and stuff, the current floating profits or losses if you have opened any trades. In here, you most definitely would see the history, your history. You can customize as to the type of history, in fact, the period from where to where of history which you want to see. Most definitely in this one, you would see things like ads. In this one, you will most definitely receive notifications. So this is an example of XM broker account. Back then, well, they have this they had this ribbon for real account. Nowadays, they do not have. We will just only see uh, the server that this is a real account. They don't have that this real that is here. So this is an example of a real account, even if the login details and the account number is hidden. But this is example of an account, a real account. So for anything that you want that you cannot see, you can just click to this search icon right here. You can click to this search icon and you search it, and then you add it to your watch list. Then you know for sure that it will appear in your watch list right here. So suppose you want to make an order. You want to make an order. You want to make an order for your USD. You are in your MT4 platform on your Android device in this case. You want to make an order on your USD. You spot an opportunity. You have made your own analysis and you spot the opportunity for you to make a trade. Okay? You would long press on Euro USD. After you have long pressed, this window will appear. When this window appear, and you will select new order. When you select new order, you will see your screen changing to this. This is up here is the type of order that you will select, the type of order that you want to make, and you will select on the lot size. This is for stop loss. This is for take profit. I don't usually use this one. I never use deviation. So then after that, you will select on buy or sell with respect to the type of order that you want to do, whether it's buy or sell. In this case, you have to understand that you will select type of order which is instant execution, which is the same as market execution. You will select instant execution. You can see that you have ability to select whether you wanna place a buy limit order, sell limit order, buy stop order, sell stop order. In this case, you have selected instant execution. Then you tap in the lot size. Then you could also type in the stop loss price point, the stop loss price area. You can type the price at which you want the market to stop you at. In here is for stop loss, and then this is for take profit. As you can see, is the below borderline is indicated with red to show that this is a stop loss, and this one is indicated with green to show that this is a take profit. Then you could select sell or buy based on what you want. So here, suppose you have placed a sell order. If you have placed a sell order with the lot size of 1, no stop loss, no take profit in this manner, you have just placed a stop loss, then the window will appear. This window will appear that tells you that your order is being placed or your order is open, which is a sell order with lot size of 1 on the pair Euro USD. You have made your sell on this point. You haven't made any, you haven't punched in the stop loss price point or the take profit price point. And then you will click on done. You will click on done. Then your order will be placed. So here I want to tell you about this one. We have this icon of arrow like a chart pointing up. This actually where you click in order for you to view your current running trades or your the trades that you have placed that are yet to be triggered by the market, or the current running losses of your open orders. In this case here, the market went in our favor. We made a profit of 5,492.90 US dollars. Current balance is $10,000. Equity is capital, which is the balance together with the running profits, that is your equity. In this case is 15,432.90. And then we have our free margin level in percentage and margin. And then this is the profit for each of the running trades. In this case, you can see this was here on USD. Let me do this. On GBP USD, you could see that it's a buy order with lot size of 1, and stop loss is placed 1.51326, and take profit is placed at 1.52497. The current running profits is $1,171 for this only particular trade. But together with these ones below, the profits are up to 5,492.90. And we also have placed a buy limit order with lot size of 1 at this price point on USD JPY. It is yet to be triggered. Okay. Moving on. How to use MT4 on iPhone. It's simply the same. Whatever you do, it's pretty much the same. We have the same things. We have market watch, your chart, the current running profits, losses, and the currently placed orders that are running, that are also to be triggered by the market, and the other ones that the market failed to trigger them. You can see them and observe them in here in trade. In history, we all know that we can access our history, and this is pretty much settings. So it's pretty much the same as with the MT4 of Android, and most definitely there are few advancements on MT5, but most definitely you will do and perform these tasks on MT5 as well. MT5 only has only thing that is new on MT5 is that you can move your stop loss and your take profit manually using your hand without punching any numbers. You can move them, and it's much faster more than MT4. And you can also close all the winning trades or all losing trades or all trades at the same time. That's the only difference. So let's talk about MT4 of PC. Talking about MT4 of PC, most definitely this is the what you will see after you have opened, you have installed your MT4 on your PC. This is the actually the interface that you will see. You will see the charts popping in here, maybe for multiple of them, and then you will see all this. This is our market watch, and then this is the profiles where you could add indicators, and this is whatever menu bar, toolbar. So let's get deep. So this is actually example of forex time broker account, which is FXTM. This is market watch, as indicated right here. It's market watch. You can add whatever you want to see in here to your chart for you to see it. But first of all, when you sign in your account, you will need to select the server of your broker. In this case, there are these servers of the broker. You will need to select your server, and after you have selected your server, you will need to punch in the login details, your password, and your account number or your account ID. And then after that, you will have signed into your account. After you have signed into your account, you can be in the position to manipulate everything. Uh, Down here, you will actually see the account, the balance. It will be written, most of the time it will be written trade. This is where you will see the balance, the margin, anything of your account, and the running profits if you want to see them. Also, you will see the history of your trading account. This is where you can manipulate and add the expert systems. You can read the mailbox, the alerts, whatever, the articles. I don't usually use that. I never read articles. I never use this. Any whatever is on this tab, I never use it. So I only use trade and account history only. So if you want to log into your account, you will actually come to accounts here, and then you right click, you select on login to trading account, and then if it's an existing account, you will select existing account, and you will select the broker, and then you will type in the account number or account ID and the password, and you click on save if you are on your PC and then you don't want to continue every time typing your login details. Then you click on finish. Then the account will appear. Then you have your market watch. You have your menu bar. You can do auto trading. uh, on files. You can do a lot of stuff. Can do a lot of stuff here. You can insert indicators on your chart. You can navigate on the tools. You can go to help. You can view uh, different things. You can view market watch. You can remove market watch. When you want to see market watch, you can click on view. You can view the navigator. You can delete navigate. You can delete this terminal, this lower terminal, that you will be able to see your current trading history and your balances and stuff. You can actually do many things. You can do many things. So suppose you want to take an order, okay? Suppose you want to take an order. Let's make an example as to what you will actually do. You want to take an order. If you want to take an order, suppose in this case is AUD USD. You want to take an order for AUD USD. You right click on AUD USD and then you will select on chart window so that AUD USD appears on your chart. Then you will come here below. You will right click anywhere here. You right click and when you right click or you double click, you can do whatever. You can right click, you can double click, or you can come here on the tab and find this icon where next to it is written new order, and you click on it. When you click on it, this menu will pop up. When this menu pops up, then you can select the volume, which is the lot size. You can type in the stop loss area where you want to put your stop loss and your take profit, and then you may write a comment if you want to. Then you can type you can select the type of order that you are willing to do. Is it a market execution order? Is it market execution order, or is it an instant order, or is it a buy limit, sell stop, buy stop orders? Then you will you click on sell or buy after you have selected that. That is pretty much it. This is how you use your MT4. As we said that here on the lower terminal, there will be your balance, your equity and free margin, and withdrawals as well if you have made any withdrawals. So they will appear here. This is your account history. This is exposure, news, alerts, mailbox, and many of them. And this is actually the speed at which your network has connected to the internet with respect to your trading platform. So this is pretty much it. This is the full basic foundation of FX Pioneers Trading Institute. Thank you for watching. If you want to enroll for the BTMM mentorship course, then you go ahead and enroll for it. Follow the rules, and you need to meet the requirements in order for you to enroll for the BTMM full course. Tell me how you have understand everything. You came to understand everything. Tell me any comments that you may have. Thank you for watching.